The truth is, most people never figure this out. They spend years believing that if they didn't start investing in their 20s, they have already missed their chance to build wealth. They watch videos about compound interest, hear stories of people who became millionaires by investing early, and convince themselves that it's simply too late to catch up. If you enjoy videos that simplify investing and help you make smarter financial decisions, make sure to subscribe because today's lesson could completely change how you think about your financial future. 1. Why so many people wait too long to invest. Most people don't avoid investing because they're lazy. They avoid it because they believe they need more money, more knowledge, or perfect timing before they begin. Some spend years paying bills, raising children, building careers, or recovering from financial setbacks. Others simply assume they'll start next year. Before they realize it, 20 years have passed. When they finally decide to look at retirement accounts or investment portfolios, they immediately compare themselves to people who started decades earlier. That comparison creates panic. But comparing your beginning to someone else's 20-year head start serves no purpose. Every investor starts somewhere, and the most important decision is not when someone else started. It's when you choose to begin. Many successful investors didn't build wealth because they had perfect timing. They built wealth because they eventually committed to consistent investing and stayed disciplined for years. 2. It's later than you planned, but earlier than it will ever be again. One of the most powerful truths in personal finance is this: the best time to invest was years ago. The second best time is today. Waiting another 5 years won't improve your situation. It simply reduces the amount of time your investments have to grow. Even beginning at 50 may still provide 15 years or longer depending on your retirement plans. That is far from insignificant. The important thing is shifting your mindset away from regret and toward opportunity. Every month you invest gives your money another opportunity to work on your behalf. The future doesn't care when you should have started. It only responds to what you do from this moment forward. 3. Stop trying to catch up overnight. One of the biggest dangers for late investors is becoming impatient. Many people believe they must double or triple their money quickly to recover lost time. As a result, they begin chasing risky investments, speculative stocks, cryptocurrency hype, or unrealistic promises of enormous returns. Unfortunately, this often creates even bigger financial setbacks. Successful investing is rarely exciting. Remember, investing isn't a race against other people. It's a process of gradually building financial security over many years. Small investments made consistently often outperform large investments made emotionally. Patience may not feel exciting, but history has repeatedly shown that disciplined investors often outperform those constantly chasing the next big opportunity. 4. Make investing fit your life. One reason people delay investing is because they assume they need thousands of dollars before opening an investment account. That simply isn't true. Modern investing allows many people to begin with relatively small amounts while gradually increasing contributions over time. The most effective investment plan is one you can realistically maintain every month. Whether you're investing weekly, bi-weekly, or monthly, consistency matters more than occasional large deposits. Automatic investing can also remove emotion from the process. Instead of trying to predict market movements, automatic contributions allow you to invest regularly regardless of short-term market headlines. This habit not only builds wealth over time, but also removes much of the stress associated with deciding when to invest. The goal isn't perfection. The goal is consistency. 5. Focus on what you can control. The stock market is unpredictable. Interest rates change, inflation rises and falls, economic conditions constantly evolve. These are things individual investors cannot control. What you can control is how much you save, how consistently you invest, how diversified your portfolio becomes, and how disciplined you remain during periods of market uncertainty. Instead, it becomes based on habits you repeat year after year. Financial success is often less about predicting the future and more about consistently making smart decisions regardless of what the future brings. 6. Choose investments that match your time horizon. One of the biggest mistakes people make after starting to invest later in life is believing they should either take extremely high risks or avoid risk altogether. Neither approach is ideal. The right investment strategy depends on your retirement timeline, financial goals, and personal comfort with market fluctuations. The goal isn't to find the perfect investment. The goal is to create a portfolio that you can confidently hold through changing market conditions without making emotional decisions. 7. Asset allocation is more important than finding the next big stock. Many beginner investors spend countless hours searching for the next company that could multiply in value. While finding successful investments is certainly valuable, experienced investors understand that overall asset allocation often has a greater impact on long-term results than picking individual stocks. Asset allocation simply means deciding how your investments are divided among different types of assets such as stocks, bonds, and cash equivalents. The appropriate balance depends on factors including your age, financial goals, and willingness to accept investment risk. Someone approaching retirement may prefer a different allocation than someone who is just beginning their career. As you move through different stages of life, your investment strategy should evolve as well. 8. Increase your investments every time your income grows. One of the smartest habits any investor can develop is increasing investment contributions whenever income increases. Instead of allowing lifestyle inflation to consume every additional dollar, commit to directing part of every future pay increase toward your investments. Automating these increases makes the process even easier. Rather than relying on motivation each year, you create a system that steadily builds wealth with very little ongoing effort. The secret isn't making one massive investment. The secret is consistently investing more as your financial situation improves. 9. The biggest mistakes. Late investors must avoid. Starting later doesn't automatically put you at a disadvantage. Making emotional decisions does. One of the biggest mistakes is constantly delaying your first investment because you're waiting for the perfect market opportunity. Markets naturally move up and down, and no one can consistently predict exactly when prices will reach their lowest point. Another mistake is checking your investment account every day and allowing short-term market fluctuations to influence long-term decisions. Investing requires patience. Temporary declines are a normal part of investing, not necessarily a sign that your strategy has failed. 10. Your financial future starts with one decision. The difference between people who eventually build wealth and those who never do often comes down to one simple decision. They start. Not because they know everything, not because the economy is perfect, not because the stock market guarantees success. They start because they understand that waiting accomplishes nothing. Imagine yourself 10 years from now. Would you rather look back wishing you had invested today or feel proud that you finally took control of your financial future? Time will continue moving forward regardless of what you choose. Your money, however, only has the opportunity to grow if you give it the chance. Starting at 40, 45, or even 50 doesn't mean you've missed your opportunity. It means your opportunity begins today. The future version of yourself won't care that you started later than someone else. They'll care that you started at all. If you found this video helpful and want more easy-to-understand investing and personal finance content, don't forget to subscribe. Thanks for watching, and I'll see you in the next video.